the PNC Roundtable.
Hello, this is Ric DeVore, Regional President of PNC Bank, and thank you for listening to PNC Roundtable, celebrating its 5th year. It's on this show that we tackle some of the region's top issues with people who truly make a difference in our region.
Welcome into the PNC Roundtable. Paul W. Smith here, along with Regional PNC President Ric DeVore, and our annual meeting with Stuart G. Hoffman, Senior Vice President, Chief Economist, the PNC Financial Services Group. He's the principal spokesperson on all economic issues for PNC. And before we say hi to Stuart, I say hi to Ric and say, what's up, Ric? What's been going on with you?
Well, this is a happy time for us. 3rd time, Paul, we've done the show with Stuart, and we're excited to have him. I think what you're going to hear today is, in contrast to what's going on maybe in the region, a little bit on the political side, we're going to hear some positive news on the economy and positive news on the state of Michigan and Detroit from an economic standpoint. So I'm excited to have him as our guest.
That's pretty good, Stuart, given this is our 5th anniversary year of broadcast, for you to be back now for a 3rd time. And I'll just remind everyone, Stuart was here in the past these 3 times. We've pointed out that he was recognized as the most accurate forecaster in the past by Business Week, USA Today, Wall Street Journal. You read his comments, a variety of places, including those publications and more. You see him on CNBC, Bloomberg TV, etc., etc. And he comes to us today to talk about some of the things that we're all concerned about that are all around us. So Stuart G. Hoffman, Senior Vice President, Chief Economist, PNC Financial Services Group, it is indeed a pleasure to see you again. We hope you're enjoying the fine weather here in Detroit.
I am, and it is a pleasure to be back and be with you for a 3rd time. And think back to what I said about a year or 2 ago, and the economy continues to heal. It's not a healthy economy, but it's healing, and I think we have more improvement in the year or 2 ahead of us.
Well, that's good news, and that is in addition to the latest problem, and we seem to go from month to month to a catastrophic event in the government. And the latest has been, of course, the sequester, still to come. End of the month or next month after that, we run out of all money and we have to shut down government, and it's kind of ridiculous. But let's go one at a time here. Will this sequester really cause a serious economic setback? It hasn't yet, as far as we know.
And I don't think it will. It is $85 billion. That's the law of the land, although some of that, who knows, may be restored. That would knock the economy's growth by about, in our calculation, about 0.5%. It will cost several 100,000 jobs. So it's definitely a speed bump on the road to recovery, but it will not set back the economy into recession, especially since there are a lot of very good things going on in the private sector: housing, automobiles, business investment. If it were happening in isolation, 3-4 years ago, it'd be piling on. But happening today, it is going to be more than offset by some of the other positive things going on in the economy. In other words, we can absorb it.
What are some of those positive things that are going to offset whatever the negative effects of that would be?
Well, one is the automobile industry and better auto sales, better auto production. We think auto sales will be about 15.5 million this year, up almost 1 million from last year, and 16 million next year. Housing is doing well. We talked a year ago, Paul. If you played the tape back, I talked to you about the turn in housing, which at the time people said, what's this guy talking about? We thought housing would stabilize and do better. In fact, it did better than that. There was a good rebound, although from a very depressed level. But housing sales, housing starts, housing construction, and home prices in the Detroit metro and around the country are on the rise again, and we think that's another positive. Business investment, businesses investing. There was a hesitation ahead of the election last fall. That's behind us. Businesses are going to invest, and banks like PNC and others, but PNC in particular, are going to be providing the funds, as are the capital markets, and general consumer spending. Consumers aren't going to go on any spending spree, but their stocks are worth more, their homes are worth more. There are 2 million more people working now than there were last time when I was here, and I suspect another 2 million more working a year from now if you're kind enough to have me back. That's generating income. And so that is another one of those positive developments that's going on in this country to offset some of the drag from the federal and state and local government.
And Ric DeVore at PNC, are you seeing that, let's say in the home mortgage area, for example, that uptick?
We are, and what's really promising, I think, is if you remember with the new payroll tax that went into effect, auto sales and housing sales in the first 2 months, that's really a good sign. On the borrowing side, we're seeing manufacturing still doing well and kind of leading the way. But what's also promising is that the people that supply the housing and construction industries are seeing an uptick. And third, and this is really important, I think, as a great barometer, is the temporary staffing companies are seeing an uptick. The Kellys of the world, etc. That's usually a pretty good leading indicator of a region's health.
I've always wondered about that. I'd like both of your thoughts on it, Stuart, you and Rick.
Yep.
And that is, I understand there's a place for the temporary companies, but does that really show health in our companies if they aren't healthy enough or not choosing to actually make the commitment to hire someone and call them an actual employee and take on all the responsibilities of that rather than going outside and doing a temp company?
Well, yeah. Actually, what typically happens or often happens is you start out as a temp, and if you're doing a good job and the company's growing, you might get offered a full-time position. So I actually think more temporary hiring is a positive sign for the economy. It's a little like a similar vein as your current employees. You might ask them to work a few extra hours, particularly in manufacturing, doing overtime. And that is, you're still a little hesitant to hire more because you want to make sure that demand is going to kick up. But working a little longer hours, particularly overtime manufacturing and temporary hiring, is usually a positive sign, a positive leading sign that there will be more full-time hiring by those companies once they get a little more confidence that this improvement in sales and orders is going to last. And I think we're seeing that now.
I would agree with that. And Paul, I would also add, it's kind of like steps to recovery. But with that said, I think also the change in healthcare has a lot of firms thinking, maybe I'm going to go on the rent-employ route, and do the temp thing until I figure out what our stand's going to be on, the new affordable care, healthcare legislation.
Mm-hmm.
And so for me, the mischief in the numbers might be a little bit of is how much is really real and how much might be attributable to, hey, let's maybe take a detour on this healthcare cost issue.
And Stuart, in the past, we've talked about how devastating not knowing what's going to happen or where we're headed is. But that doesn't seem to be the case now with still not knowing for sure what's going to shake out with healthcare.
Well, I think we know more. Small businesses do know more. I mean, it's the law of the land. The Supreme Court upheld the constitutionality. We do know more about taxes. The federal government passed a tax hike, and while the Democrats would like to do more, and the Republicans are resisting that. But compared to 3 months ago, as we went into the end of the year, the old fiscal cliff and uncertainty, some of that has been resolved. The sequestration, like it or not, at least you sort of know what's going to happen. So I think there's more certainty, whether you like what you know or not, but I'd still rather be more certain about things I don't like than the uncertainty that precedes that. And I do think that's where some of the business investment improvement is coming from, and even the improvement in consumer confidence. Back late last year, consumer confidence plunged, although sales held up better. In the last 2-3 months, we have data since the fiscal cliff deal and the tax rates. Confidence is coming back. It's not highly confident, but it's coming back. So I think that's a sign that there's less uncertainty, more certainty, and people will cope with whatever it is that, whether it's healthcare or higher taxes, that they have to deal with. That's what businesses deal with. Better to deal with what they know rather than the fear of the uncertainty.
Stuart G. Hoffman, Senior Vice President, Chief Economist, the PNC Financial Services Group, along with Ric DeVore, the Regional President for PNC. We're on our PNC Roundtable. What do you say, Stuart? When will the Fed stop buying securities, start raising interest rates? What's your crystal ball telling you?
Well, first off, the backdrop there is the Fed's buying $85 billion of securities every month, which is a huge amount, sometimes referred to as quantitative easing. I think they're going to keep that up all year long, Paul. They might trim it back from $85 billion to half of that as we get towards the end of the year. I don't think it'll be until about this time next year that the Fed will stop altogether. And in the interim, they'll probably added $1 trillion to their balance sheet. But even when they stop buying securities, they're not going to raise interest rates. They've talked about not raising rates until the unemployment rate is below 6.5%. That was 7.7 nationally in February. We don't have it below 6.5% until a couple of years from now. So I would say that interest rates are going to remain this low, which is positive from a borrower's point of view and painful from a saver's point of view this year and next year. And if you have me back 2 years from now and you ask me that question, I might finally tell you we're on the cusp of some increase in interest rates in 2015. Between now and then, flat as a pancake for interest rates.
All right. Well, as long as you've got that crystal ball out, what's the near-term and longer-term outlook for the federal budget deficit?
That is an interest. Near term, actually, it's getting better. Even the Congressional Budget Office, nonpartisan, represents Republicans and Democrats in Washington, has predicted for the next 3 years, 13, 14, and 15, the budget deficit is going to go down. It's still huge. We're still coming off a multi-trillion dollar deficits. But this year it'll probably be $800 billion, next year $500 billion, and the year after under $500. That's good news. That gives our elected officials, us and our elected officials, some time to make some of those long-run, tough cuts in entitlements. Because after 2015, the deficits start getting worse again, and it'll be headed back up to $1 trillion by the end of this decade. So the near-term outlook is quite positive as the economy's done better and we've hiked taxes. Whether we really do something to get it under control or get our fiscal house in order over the next 5 to 10 years, we need to see the Republicans and the Democrats finally agree and tackle some of the tough issues on entitlements, health care, but also Social Security.
And, Rick, how does that affect you in running a business like running PNC?
Well, I think when you look at it, those two issues are really related, and it's the intersection of this forecast of rates and this inability or ability to get the deficit down. Because the issue is, if you forecast out when rates are going to go up, if we don't get at that, don't forget the interest payments the government has to pay are going to go up dramatically, at that point. And so I think Stuart's point is well taken, and that is that if we can get the deficit down before rates start going up, that really behooves the American public. Otherwise, these payments are going to double or triple. And, just like consumers' rates would go up. Mm-hmm. So to me, we have this kind of little lull, if you will, or a period where we really got to get at those issues. Whether you're optimistic whether they can in Washington or not is another issue. And, we're not here to make political commentary, but the fact of the matter remains that there has to be some big changes on some of the entitlements out there. We're just not going to get at it.
The deficit wolf is not at the door, but he's out there in the forest headed our way.
Yeah, not far away, really. And we can do all of those things right. We can fix all of that. I'm just presuming that be the case. Let's pretend that the Democrats and Republicans get together, work together, serve us, we the people.
Yep.
But we can't control what's happening with Europe and right. The recession there. Any of your thoughts on that, Stuart, I'd be interested in.
Yeah, the recession in Europe is still getting worse, and particularly in southern Europe, in Spain and Italy, Greece. It's really a depression. I mean, particularly in Greece and Spain, you have unemployment rate of 25% and youth unemployment of close to 50%. If that happened in this country, one can only imagine what would be going on. So Southern Europe is in a depression. Northern Europe is still in recession. We expect by the latter half of this year, Germany, France, the UK, Netherlands will actually start to show some signs of growth and a little more next year. But Europe is by far the weakest continent. We're doing better here. North America, the U.S., Canada, Mexico, South America, Asia, even Africa. Europe is still in recession, will likely be so, and even when they come out, it looks like it's going to be slow growth for Europe for a number of years to come.
Last report for you mentioned unemployment and what have happened if we have that kind of unemployment in the U.S. Yep. We don't want to find out.
No, we don't.
But last report it was down, surprising some people, and then people always come out and say, well, it's because people dropped out of the job market. They're not even looking for a job. Whatever it might be, I don't even care at this point. What I do wonder about, and since I've got Stuart Hoffman with us, Senior Vice President, Chief Economist of the PNC Financial Services Group with us, will the U.S. unemployment rate ever get back down to 6%?
Yes, I think it will. It won't get there this year or probably next year, but I have every reason to believe that we have a diverse enough and energetic enough economy to get there by 2015 or 2016. So we're still healing. 6%, I even see no reason why we can't get down to 5 or 5.5%.
How long ago were we there in that ballpark?
2007, before the near depression of 2008 and 2009, the national unemployment rate was below 5%. It was below 5% in the late 90s. We can do it. If we got our fiscal house in order and this energy that we're finding in this country and continue to develop, whether it's shale gas or oil and less dependence on the Middle East. As I say, Paul, when I get this optimistic, you should probably pull the plug on me and I lie down and
I'm starting to worry
get over it. But if we
Quick,
got
let's get out of the market right now.
if we could, exactly, a perfect contrary indicator. But if we become more energy independent or less dependent and do some fiscal house in order, the latter half of this decade could surprise people how good it is. And a lot of that is in our own hands. So we're going to go to a 6% unemployment rate in probably 2 or 3 years, and we could go lower if we do some things right in the interim, both in energy policy, or at least in the energy markets, and most importantly in our fiscal policy, our federal health.
Mm-hmm. Your thoughts on that? What do you think of fracking? Do you take a stand
well,
on that?
from some, I come from Pittsburgh. That's where PNC is headquartered. We do a lot of it there.
Yeah.
It's been a major positive for our region. So I'm very, shall we say, pro-fracking. Obviously, there are environmental issues and tax issues, but it is, I think, been very positive for Eastern Ohio. It's been very positive for southwestern Pennsylvania and North Dakota, and there's a lot of energy there. So I think if we do it right, and we can do it right, it's jobs, it's tax revenues, federal, state, and local, and it's energy and low natural gas prices, which can bring some manufacturing jobs back to this country. I think it's if not a godsend, it's a Mother Nature benefit for the U.S. economy if we develop it right.
Rick, some of your take on Stuart's optimism. What was the expression that the emperor used? Something about
had no clothes.
No, the about enthusiasm, and it was actually about Japan at the time, and I can't remember. It'll come to me as we're talking. But what's your take on Stuart's enthusiasm?
Well, I think sometimes we fixate, I think, on some of the political negatives and seem to dominate our headlines. And you and I have talked about this before. Mm-hmm. But, if you look at the core economic data, granted we're coming from an awful situation in 2008 and 9, but we're cautiously optimistic. We're not seeing the hockey stick recovery, but we're seeing recovery in a few years. We put a few years in a row. We're pretty optimistic. Regarding fracking, I will tell you, for hotel owners in Eastern Ohio and Western PA, it's been a godsend. You cannot find a room at a Hampton Inn or Comfort Inn anywhere because a lot of these hotels have been booked completely by fracking companies.
But more than that, I mean, it's not just the hotel boom. It's employers, right. It's community colleges that are training people. It's part of the reason why the unemployment rate in southwestern Pennsylvania is 7%. Almost 1% below the national average. There are many other things going on there, and why in North Dakota it's below 4%, and so it has tremendous what we call multiplier ripple effects. And by the way, Paul, it's tempered enthusiasm. I'm not sitting there predicting that's all going to happen. I'm saying there's a potential if we do some things right. Clearly, if we don't, I could sound as negative as an economist is supposed to be if a couple of years from now we really screw this one up.
Well, part of this enthusiasm is his upcoming marriage in June. So I think maybe we have to caution, put a little star next to the forecast.
Everything.
That's right. I'm a man in love.
Mazel tov. Congratulations.
Thank you.
I didn't have any idea.
That's it.
Well, good for you. I'm a big believer in marriage. Irrational exuberance is what I think I was trying to think of.
That's
irrational exuberance. What was his name? He just had a birthday.
Chairman Greenspan.
Yes, the Emperor Greenspan
said that in December of, would you believe, 1996.
Oh, boy.
He said that 3.5 years before the stock market peaked, and right now the market's triple. When he said that, the Dow was about 6,000 at the time, having gone up. But yes, we are coming up on how many years since 96 since Greenspan said that. So he was the emperor. I think he had some clothes. Although
he has proven to be fully dressed at times.
At the end, he's been denuded, but I think he had a pretty good wardrobe.
And a pretty nice wife, Andrea Mitchell, from
very nice.
The news person. Yeah.
Yes.
The outlook for inflation at this point, Stuart?
Well, I'm fairly positive that the Fed's target is 2 to 2.5%. 2%, but they're willing to tolerate a little higher. Certainly, if you listen to all the commercial about the gold bugs, inflation's gold's going to take off. Inflation, because of what the Fed's done, is an accident waiting to happen. 5-10% inflation. I don't buy it. If the Fed totally screwed up, and Bernanke may not be there a year from now because his term expires at the end of January of next year, and President Obama can choose to reappoint him or not. But even if he doesn't, I think there'll be continuity within the Fed. Janet Yellen is a name to keep in mind. She's the vice chairperson, a woman, and likely to be nominated to be chairman if the Fed doesn't. And I think the Fed will drain some of this liquidity over the next 3-4 years. So I'm not in the inflation camp. I mean, it could get up to 2% or even 2.5%, 3%. That's not going to make gold go to 2,500, and that's not going to be the inflationary fires that some people think that's going to burn up the U.S. economy. So I'm in the 2%, 2.5% inflation guy for the next 3 to 5 years, and those people that tell you it's going to be a lot higher than that should be buying gold, and I'm not.
That was to the point. Well, some people are looking at gold and wondering about gold. All of us are looking at gasoline prices and where they are and where they might be headed.
Well, 2 years ago when we were here, Paul, gasoline had run up as it has typically in February and March, and there were people saying $5 a gallon national average. I said it'll peak at $4. It peaked at $4.04 based on AAA. Last year, it ran up in February and March. Same thing. It peaked at $4, actually just shy of $4 at Easter. I'm thinking we're going to peak at $4 a gallon again. Right now, the national average based on AAA is around $3.75. Of course, it's more in California, and it's a lot less in the Southeast. My guess is that between Easter, which is the 31st, and Memorial Day, well, $4 national average, and that'll be as high as it goes. And again, between Easter and next Christmas, it'll fall back to $3.50 a gallon, just like it did the past 2 years.
We do have short memories in these areas, don't we?
What'd you
Maybe
say?
not you.
What did you say?
The rest of us.
Oh, yeah. Yes, we do have very short memories.
The rest of us.
The rest of us. This is going to be the third year in a row. Same story. Gasoline at $4 and then coming back down. And that's because oil is about $92 a barrel for West Texas. It ran up a little bit, but I don't think oil's going $100 a barrel. So if it doesn't, gasoline's not going above $4 a gallon.
What an experience this last trip to the Geneva Motor Show in our broadcast. In the past, many years ago, if I had the greenbacks, I could use them anywhere. People loved our dollars.
Yep.
That went away. Then it was the euro. You could use the euro. Well, guess what? When I tried to pay a cabbie in Geneva with a euro, he goes, no euro. Swiss francs.
Back.
Swiss francs.
Oh,
well, I didn't ask him what order, but I have a feeling it was Swiss francs, dollars, and then euros. Where do you see the dollar? What's the outlook for the U.S. dollar? The other day, we were doing better than we, I think, have in a long time against the pound, which is a very big deal. What's your thought?
Well, we just talked about Europe being in a recession, low interest rates. I think we talk about the euro at $1.30. $1.30 U.S. to buy a euro, maybe even down to $1.25. That would mean a stronger dollar. The pound you just mentioned, it just went under $1.50 U.S. to get a pound. I wouldn't push that one too much further, but again, Europe, including the U.K., is weak. So maybe we are going to stay at around $1.50. Japan, Abenomics is a new they're doing what maybe they should have done 25 years ago. They're trying to generate a little inflation, talking about low interest rates and doing some of that same bond buying that the Fed's doing. We're going up probably towards over 100 on the yen, and it wasn't that long ago. It was 70. So the dollar is stronger. I think the dollar against the Canadian dollar, it'll stay about $1. Against the Australian dollar, against the Swiss franc, it'll probably stay where it's at. But against the pound, the euro, and the yen, I think our dollar is going to stay the same or get a little stronger over the coming year.
Is the euro at risk at all? Or do you see the euro going away and these guys going back to their own currencies?
No, I mean, there was fear of that a little while ago, and then Mario Draghi, the head of the Central Bank of Europe, Ben Bernanke of Europe, came out last summer and said, we'll do whatever it takes. And they have. They provided liquidity. You don't hear people saying Greece is going to drop out of the euro or the euro is going to disintegrate. I mean, if you ask me 5 years from now, yeah, maybe Greece is out of the euro, but it's still going to be a main currency block. It'll stay together. It'll still be led by Germany and France. So I don't think the euro is going to disintegrate, but I think the value of the euro, as I said, will be stable to lower against the dollar over the next couple of years because the U.S. economy is going to do better than Europe's economy.
Sure. The problems in Europe are not similar or are similar. are the same or far worse than the problems we just went through the last few years? I get the impression that for whatever reason, and you'll tell me why, it's much worse in Europe.
I think it is worse in Europe. I mean, it works in Europe. They did have a difficult environment. They've gone into much more austerity. They've got different work rules. They've got different culture. It's more similar to what's happening in Germany. But France, Italy, it's different in terms of work rules, particularly in France. The demographics are very different. The labor mobility is different. So I actually think it's relatively better here than it is in Europe for a variety of reasons. The monetary policy, the fiscal policy, and some of these basic cultural and demographic and government policies. And I think that favors the U.S. You know, when I got in this business 30 years ago, we talked about Eurosclerosis. In the 70s, Europe didn't grow. Then it did a little better in the 80s and 90s and, last decade. But we're back to Eurosclerosis. That is a region that its economy is hemmed in by a lot of factors. So I think it is definitely worse in Europe as a group, better in some countries than other, than it is in the U.S. Give me the 50 states of the U.S. anytime versus the European Union in terms of economic growth.
Absolutely right about that. What's your outlook for the developing economies, though, such as China and India, for example?
China was weak last year. They're starting to grow again. They'll probably grow around 7.5% to 8%.
But that weak is relative, right?
Well, yeah. I mean, when they say
weak compared to the on-fire growth that they were experiencing,
right, compared to 10 or 12%, 8% is probably like us growing 2.5%. That's sort of normal for them. Now, India, though, has been growing more slowly. The Indian has a great potential. The Indian economy has great potential. So I actually think if you look out over the next 5 to 10 years, there's more potential growth in India than there will be in China.
And I'm thinking, as an economist, you would prefer the slower growth. Maybe? I don't know.
Well, I don't know if I prefer it. I mean, whatever they can handle. For China, growing 12% for them was inflationary. They preferred slower growth. In India, I think they prefer faster growth because last year they slowed down to around 4%. So I actually think faster growth in India, if it can be achieved, would be desirable for them, the Indians, and the world economy. Brazil. The Brazilian economy has slowed down. They did pretty well before the big crisis. They're trying to grow faster again and take part of Latin America or South America with them. And Russia. Usually we talk about the BRIC economies, BRIC, Brazil,
right.
Russia, India, China. China's growing again. India's growing. Brazil, Russia's hard to tell. But I think we're going to see faster growth, and even in Africa, in the next couple of years than we did last year.
We don't even go to the Tokyo Motor Show anymore. What's going on with Japan?
Well, for 25 years, Japan hasn't grown. It's been in and out of recession. It's had deflation. As I mentioned earlier, Abe is their new prime minister, Abenomics, to nickname it. He's just put a new Fed governor in, head of their central bank, Bank of Japan, to try to stimulate the economy. They're trying to get companies to give wage increases to employees to help generate some economic growth and, believe it or not, to generate a little inflation in the sense that not a lot of too much inflation is not good. A little inflation can actually grease the wheels of commerce. And that's what, after 25 years, the sea change in Japanese economic policy in just the last 3 or 4 months is startling. And the hope is that Japan could grow 2% a year for the next 4 or 5 years and actually maybe make Paul want to go back to the Tokyo show because the economy's moving ahead again.
These are decisions made well over my head.
I understand, but
they point and I go.
Me too. That's why I got to Detroit.
And we're glad you got to Detroit.
And so am I.
And I know, Rick, you're happy when Stuart makes it to Detroit as the principal spokesperson on all economic issues for PNC. It's a special treat to have Stuart G. Hoffman with us. And I'll let you give us the final word, Ric DeVore, on what you're going to be doing with Stuart for the balance of his visit and some other thoughts as well.
Well, we're going from here, as you know, to the Detroit Economic Club. I'm the presiding officer, and this go-around, and Stuart's our featured speaker. And as you know, with Beth Chapel, that's a prestigious club and an honor to be the speaker there. With that,
it's an honor to be the presiding officer as well.
Yeah. Yes.
I have very limited duties. I like that. No. You asked earlier about what does this mean, and obviously, it's better right now to be a borrower is not a bad thing. Whether you're, getting a residential mortgage, getting a car loan, or as a corporation. I think on the saver side, especially on our retirees, next couple of years are going to be a little bit tricky, and I think that's why we favor stocks over bonds and fixed income investments. And so I think it depends who you are. I mean, a little bit of inflation might not be bad for the retirees down in Florida and Arizona, but not a bad time to be a borrower.
Mm-hmm. Mm-hmm. Is it a good time to be in the stock market, Stuart, still?
We think it is. Obviously, you've had a big run in the market, and, there's an inevitable correction, and then, somebody on CNBC will come on and say, this is the beginning of the end, 20, 30%. I call them vampire economists.
There are many experts who are telling us that this is the beginning of the end or the beginning of the greatest expansion. We don't know, and I have a lot in common with them because I don't know either. They just don't admit it. I do. And I guess just being a wise investor and not trying to be a market timer is probably the best thing to do.
Well, I'll admit I don't know either, but I'll give you an educated judgment, and that is PNC likes the stock market. We've had a big run. We're up over 10%. Inevitably, something, whether it's Europe, will come out, and the market will go down 5 or 10%, and all those vampires will be on there, with their fangs showing, saying, get out of the market, last chance. They said it in 2010, 11, 12. They've been wrong. So I guess we'd say if the stock market sells off, don't sell into it, and maybe buy into it, and definitely don't buy into the negativity. You're going to hear that this is the beginning of a 20 or 30% drop. This is 2008 all over again. Because if we're even close to right about the economic fundamentals and the profit outlook, the market can easily go down 5 or 10% in a heartbeat, but not 20 or 30% unless the economy is a lot more rotten than we think it is.
Happy to see whatever losses people had, generally speaking, they've gotten back and now starting to have a little growth on that. Is there any way to protect whatever gains you might have had?
Sure. I mean, if you're really concerned, you can go into cash. You can get part of your money. When I say we like stocks, that doesn't mean you go 100%. But if you are concerned, you could pull a little bit of money out. You'll lose some opportunity, but you'll feel safe. There are ways to hedge it. And, PNC advisors could certainly do that in terms of giving you some alternatives rather than just pulling the money out. You could buy some options, things that are not fancy derivative, cutting edge things that are pretty straightforward that say, okay, I've got some downside protection. If the market does go down 5 or 10%, I'll actually make a little money to offset what I'm going to lose, the classic hedging. So there are plenty of ways to do it without going to the ends of the earth. And yet, if that's, and I would recommend that for people. Now, if you think the market's going down 20 or 30%, you ought to just sell and get out of the way. But those are the guys who've been saying that for years, and they're not the ones, they're not in the market to enjoy these record highs that we're enjoying now. But by all means, you can hedge, and that's maybe smart to do after the market's gone up 10% in just a little over 10 weeks.
Yeah. We're 65%, right?
Yeah, PNC is 65 equities, 35 fixed income. We've been that way. We're going to stay that way. If the market sold off, we might add a little to equities. But
isn't it inevitable for a sell-off? It's just not knowing how much it's going to be.
Well, yeah, I mean, I don't know what's inevitable, but it is highly likely that after this big run-up, you'll give some of it back. But as I say, giving back 5 or 10%, getting you back to where you were 2 months ago is different than going off 20 or 30% and getting you back to where you were 3 years ago. So a sell-off, if not inevitable, is highly likely. And when it happens, ignore all the vampires telling you on CNBC that this is the time to get out. They'll be wrong again. And hang on to what you got. If you've hedged, all the better. If you haven't, don't run for the exit.
So when you go on CNBC, do they fight you a little bit, or do you fight them a little bit?
I like
spar.
I'm old enough that I'm old enough they can't fire me anymore, just about. So I'm going to say what I think, and yeah, I like to battle with some of these people, but CNBC's got to put some of the Pollyannas on there. They got crazy guys that say trees grow to the sky, and you got to ignore them too. But ignore the really negative people who've been wrong for so many years.
And Stuart G. Hoffman has been right for so many years. Senior Vice President.
Less wrong.
Chief Economist, the PNC Financial Services Group. He is the principal spokesperson on all economic issues for PNC, and we're so happy that Ric DeVore brings him in here at least once a year. We have our annual little get-together, this our third one, in the 5th year of the PNC Roundtable. And now the final word from the regional PNC president, Ric DeVore.
I think the final word is really cautiously optimistic. I mean, again, this is not going to be a robust recovery in our region. It's going to be more of a tempered one, but we're clearly going in the right direction. And I think that's really important for people to note. And some of the bellwether industries, not just the autos, but the housing, are coming back. And I think that definitely gives us pause for pretty good optimism for 2000, not only 13, but 14 as well.
For Stuart G. Hoffman and our co-host, Regional PNC President Ric DeVore, and for everyone at PNC Roundtable.